Welcome to Mysteel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at Mysteel Global. From July 10th to 16th, China's LPG market rebounded sharply. Brent crude rose by around 10% from the July 3rd to 9th period. Saudi CP price expectations moved higher, and China's domestic LPG prices increased. What stood out was that prices were on the rise even as domestic production and import arrivals increased. So, what was the market really responding to? Joining us today is Ibo, lead LPG analyst at Mysteel Oil Chem. Ibo, welcome back.
Thanks, Nikki. Great to be here.
Let's start with the highlights. Tensions between the US and Iran escalated, pushing energy markets higher. So how quickly did that impact ripple through to China's LPG market?
The impact was felt across the LPG value chain pretty quickly. As tensions in the Middle East intensified, concerns about potential disruptions to shipping through the Strait of Hormuz drove international crude prices higher, and LPG prices moved right along with them. Saudi propane CP expectations rose by more than 10%, while CFR, South China propane prices also increased significantly. These higher international prices were quickly reflected in China's domestic LPG prices. At the same time, buying activity picked up noticeably. Instead of waiting for prices to stabilize, many buyers moved to secure cargoes early, anticipating that import costs could continue rising if geopolitical tensions persisted.
We know that refinery production recovered and LPG import arrivals increased substantially this week, yet China's domestic LPG prices still moved higher. With supply improving, why didn't that put pressure on prices?
It's because market attention shifted from current supply to future supply security. Refinery output picked up as maintenance at several plants wrapped up, and import arrivals also increased considerably during the period. At the same time, concerns over potential disruptions to Middle East exports pushed downstream buyers to replenish inventories earlier than planned. That stronger buying interest offset the increase in supply and supported spot market activity. Looking ahead, import arrivals are expected to increase further in the coming week, while domestic refinery production is likely to ease off a bit. With more cargoes entering the market, China's overall LPG supply is expected to increase. So the question now is whether that stronger supply starts to rebuild inventories.
So the takeaway isn't how much LPG was actually available, it's how buyers viewed the supply risk over the coming weeks. Let's turn to demand. Did the bullish sentiment reflect stronger end-user consumption, or was it mainly driven by inventory replenishment?
Replenishment was the bigger driver. Demand from the petrochemical sector kept improving. PDH operating rates increased as more units resumed production, supporting propane consumption. Residential fuel demand, however, remained weak, with no significant change in end-user consumption. Against the backdrop of rising international LPG prices and uncertainty over future supply, many downstream buyers chose to bring forward their purchases. That accelerated refinery sales and reduced producer inventories. In the coming week, chemical demand is expected to strengthen further as additional PDH units restart. The market will also be watching whether replenishment buying holds up once the geopolitical tensions begin to ease.
I see. So, the increase in China's domestic LPG prices wasn't simply driven by stronger consumption, it was also supported by a shift in purchasing behavior, as buyers responded to rising international prices and concerns over future supply. Let's move further down the value chain. One interesting development was the divergence in downstream profitability. PDH margins improved, while alkylation margins continued to weaken. Both sectors rely on LPG as feedstock, so what explains the difference?
For PDH producers, propylene prices increased sharply alongside the rise in crude oil prices, allowing processing margins to recover into positive territory despite higher LPG prices. Alkylation producers faced a different situation. Feedstock costs continued to rise, but alkylate prices didn't increase at the same pace. As a result, margins narrowed further during the week. This provides a good indication of where incremental LPG demand is likely to come from. As long as PDH margins remain positive, the sector should continue to support propane consumption over the coming weeks.
Interesting. We also can't ignore inventories. Producer inventories declined, while port inventories increased during the week. What does that tell us about market conditions?
Those two inventory indicators reflect different parts of the supply chain. Producer inventories declined because downstream buying became more active, allowing refiners to move cargoes more quickly. Port inventories, on the other hand, increased as more imported cargoes arrived, particularly in South China. Taken together, this suggests that buying activity was strong enough to reduce refinery inventories, but not enough to offset the increase in imports. For the market going forward, the key question is whether import arrivals continue to outpace demand. If import increase as expected and replenishment buying becomes less active, port inventories are likely to continue building, which could put downward pressure on China's domestic LPG spot prices.
So, after China's domestic LPG prices were lifted by geopolitical tensions and stronger buying interest, what will determine the market's next move?
Geopolitical developments will still remain the biggest variable. If tensions in the Middle East remain elevated, they'll continue to influence crude oil and international LPG prices. For China's domestic LPG market, however, the focus is gradually shifting back to fundamentals. LPG import arrivals are expected to increase to more than 900,000 tons in the coming week, while additional PDH units are scheduled to restart. The key question is whether stronger chemical demand can absorb those incoming cargoes. If import arrivals increase as expected and replenishment buying begins to fade following the recent increase in domestic LPG prices, the market is likely to lose momentum. We expect China's domestic LPG prices to ease by around 30 to 50 yuan per ton over the next week.
Thank you, Ibo, for sharing your insights. Last week demonstrated just how quickly geopolitical developments can influence China's LPG market, from international benchmarks and domestic pricing to purchasing decisions, downstream margins, and inventory movements. As the market moves further, attention is likely to shift from the initial geopolitical reaction to whether stronger chemical demand can absorb the increase in import arrivals. Ibo, thank you again for joining us, and thank you to all our listeners. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through Mysteel Oilchem's latest China LPG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to Mysteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.